Hi, thank you for tuning in. Welcome to the It's Your Money and It's Your Estate workshop series brought to you by our nonprofit organization, Financial and Estate Literacy. Our mission is to empower people like you to take control of their finances, their estate, and charitable giving decisions. For the past 25 years, our founder, Peter Coate, and our entire team have been providing these free, unbiased, and accessible 6 weeks programs all over Orange County, California to help you make informed choices that align with your unique needs and values. Now let's start the program. This webinar is the fourth session of the It's Your Estate program. The topic is retirement asset planning. Our guest speaker is John Prichard, and our moderator is Peter Coate. Enjoy the workshop.
Everyone, I'm Trevor Murphy. I am a professional fiduciary and a colleague of Peter Coate, who is normally your moderator for these webinar series. These are community education programs for financial planning and estate planning that we conduct in the communities all over Orange County, and then also online here on our webinar series, live webinar series. So thank you for participating. Today's topic is retirement account planning. And before I introduce John, and John's an incredibly experienced financial advisor, and you're going to hear a lot from him. But I wanted to just kind of set the table a little bit regarding these assets. These assets that we're going to talk about today are called, in the estate planning world, income in respect to decedent assets, IRD. And IRD assets are we're going to learn about the functionality of them and all that, but essentially from an inheritance side, when they get, when you are going to pass these assets on, at least the part of it that you don't use, to your heirs, whether they're children, whether they're your spouse, whether they're grandchildren, whether they're friends, whether they're charities. You're going to do this through beneficiary designation forms. Okay. And if you fill out the forms correctly and there's no problem, then there's no probate. Most likely, no probate. But if you make errors or you don't fill them out correctly, these are easily a ticket to probate. Why? Because you cannot own them while you are alive in a revocable living trust or as community property or any of the ways you hold title that would avoid probate. They have to be titled in your own name because you are an individual taxpayer. So they are linked to you as an individual. Now, we'll learn that you can name your revocable living trust as a beneficiary of these assets, but keep in mind that revocable living trust is no longer revocable. It's a separate entity from you when you die. So you can leave it to that entity, but during your lifetime, your trust cannot own it. Okay? So, and attorneys, you've spent the last few weeks talking about all the documents in an estate plan. A will, a trust, a power of attorney, a healthcare directive, all of those, when you see an attorney and you work with them, they are going to be drafting a document. The attorneys do not draft beneficiary designation forms. You get those from your financial institution that are custodians of your IRD assets, right? So the attorneys often don't focus on these things. They consider them part of your financial life, not necessarily part of your legal life. But, we'll learn soon from John, these are becoming more and larger part of people's estates when they pass away. Okay, so we have to consider how they're going to work with our other assets and our goals and objectives of our estate plan. Okay, because, and this is the last point before I turn it over to John, or at least introduce him. Attorneys don't spend a lot of time on them. With the exception of a Roth, I mean, whoever receives these monies is going to be taxed ordinary income tax based on what they take out of their inherited IRA, and there's rules to that. And so they're not inherit, and I want you to think of it this way. They're not inheriting a gift like you would, let's say from your revocable living trust or something like that. They're inheriting your income, and they need to treat it like that. Okay. And so your job after learning today is to educate them about that, because often, a large IRA, even not so large these days, let's say $500,000 is someone inherits $500,000 through an inherited IRA. Okay. If they don't really know it's income, they think they've won the lottery. Why? Because it's usually all they need is a death certificate and an ID, and they can go into that institution and create an inherited IRA. And even though they may be warned, be careful, this is income, they could easily, if they aren't sophisticated enough to understand this and don't have financial advisors around them, they could easily take this and cash it out and do something foolish or not foolish. They've been waiting their whole life for your inheritance. I'm sorry to break that to you. But, the new kitchen or the new whatever, they spend it because it's the first money they see. And they never really know how much it is. Some random amount. We don't talk about it Thanksgiving. So that's something that you have to consider with these assets. You have to train or educate, I should say, your beneficiaries of these assets, especially if they're adult children who have not been living and working in these high tax brackets, income tax brackets, because when they get in those income tax brackets, they do not realize what they have done when they've spent that income. And they don't learn it until the next year when they when they do their taxes and their CPA says they owe $250,000 in income tax, and it's all in their new kitchen they just put in. So that's just I just want to put that seed out there so you guys understand when we're talking about inheriting these assets, these are things to consider. Okay, John. Eugene, can you put on his Acts first form? Eugene?
Yes, hang on. Sorry, I didn't realize I was going to do that.
I actually have it at the first page of my presentation, if
Oh,
that's
you
easier.
do? Oh, why don't you, okay, never mind, Eugene. John, why don't you put it on and I'll introduce you through the Ask First form. And we'll spend a little time, but I promise not too much time. Okay.
Sure.
All right. So, John, first of all, thank you for taking the time to do this. I know, we usually see you over in the It's Your Money series. And here we are in the It's Your Estate series. So thank you for taking, kind of taking the leap and doing that for us. Tell us a little bit about, you work for Knightsbridge Wealth Management. Tell us a little bit about your firm, your background, and how you kind of, came to where you are today.
Sure. I'll start with a little bit of a biography and then flip back to the important ask first question. So I helped found our firm, Knightsbridge Wealth Management, more than 25 years ago here in Newport Beach. And we work with families and individuals to help them grow their assets, whether it's retirement funds or trust funds. And we're an independent firm, which is really important. That allows us to work really closely with our clients, and we're a registered investment advisor, which means we have a fiduciary duty to put our client interest first. And we're a fee-only provider. We don't work for commissions. My background, I have a master's in finance, undergraduate economics degree. I've been involved in some of the philanthropic things around, such as the Boys and Girls Club and public library, but really I spend my time managing investment portfolios as part of Knightsbridge. So that's a little bit about my firm and me, and I'm happy to talk more about that. But you can see on the screen the Ask First form, which we can
Yeah.
uh,
So you have,
emphasize some of the things.
yeah, thank you for that. And you have a CFA. What is the difference between a CFA, a financial analyst, compared to, let's say, a CFP, which a lot of our speakers are CFPs as well?
CFP stands for financial planning, and that certificate and designation is very valuable for working with clients on planning, financial planning. I have people in my firm that have that designation that do that work. I'm more on the investment side. I'm more of an analyst and portfolio manager, which is why you see the CFA, which stands for Certified Financial Analyst. So individuals that assess and analyze investments, funds, securities, a valuable credential is CFA. And that's something I got right at the beginning of my career to make sure I was qualified to help invest our portfolios.
Okay, very, very distinguished credential, very difficult to get, and I assume difficult to keep because you have continuing education, you're constantly learning. Um, and it says there's no licenses. Does that mean you're not a good CFA?
It means I don't work for commissions. I don't sell
Okay.
insurance. I don't, yeah, the licenses come more when you're a broker working for commissions. I'm registered through the Securities Exchange Commission, the SEC, which is being a registered investment advisor, which is not a license. It's more of a registration. And that registration is what imparts on us that fiduciary duty to put clients first and be a fee-only advisor.
Yeah, that's a good point. So it's good to see you don't have any licenses to sell any financial products ever. Um, and you don't obviously practice law, but you did mention that you have a business relationship that is a fiduciary standard of care to your clients. Can you explain, just in your own words, kind of what that means in the financial services industry compared to, let's say, a legal or, I mean, not that you have to speak the legal, but what does it mean in the financial services industry?
It's one of the most important standards. It means that I have to always put clients first. And we literally do that when we're making an investment. All of our clients access that investment, buy that stock or bond before we do. And I'm big on investing my own money alongside clients, but I get to do that after all my clients go first. So part of it's putting clients first, but part of it's kind of a common sense standard of prudent management, being only investing in ways that are prudent. So managing risk, not speculating, not doing things that are questionable, and operating at the highest professional level. And there's a standard the SEC has, which is one of investing prudently on behalf of clients and putting them first.
Right. So it's you don't have a list of, let's say securities or bonds or something that, that has the commission next to it that you would put uh clients in because it would help your bottom line. You're doing it all for the client's best interest first. And okay, and then regarding your fees, do you have like a minimum, like how do you onboard clients? Like what is your process? Do you have like a consultation? Do you do it on the phone? Explain a little bit about that.
I like to begin talking to a potential investor by reviewing their existing investments
Okay.
and assessing them for inefficiencies from a cost and tax standpoint. So I know today we're talking about retirement plans, but across the comprehensive portfolio, really trying to see if there are any ways we can improve the portfolio from a cost standpoint, tax effectiveness, cut down fees that are associated with their portfolios, and just make things more efficient. So we're usually starting with a written evaluation where we show clients imperfections. Oftentimes people haven't really had an independent assessment of that in some time. So I want to be that third party that can take a fresh look, run their portfolio through some analysis, and put it in writing and outline improvement potential, and also outline any transition if that portfolio comes over to us, what that's going to look like. So the client would start with us knowing exactly what they're going to get and showing there's a lack of adverse tax implications in any transition. So that's usually where we start, is an evaluation at no cost that's in writing.
Okay, great. And then if the client likes what they see and likes your sort of, I guess, for lack of a better term, bedside manner with them as they're you know, tr- prudently trying to invest their hard-earned retirement accounts, for example, they would circle back, and then you'd have a sort of an onboarding client situation. And then you don't really, is there like an insurance salesman, life insurance salesman down the hall from your office that you kind of, throw clients to him and get, he gives you a little kickback? You don't have any of that
No,
going
we
on?
don't. We don't affiliate or derive any compensation from anything with attorneys or insurance or anything. Um, what I do try to do is make sure someone has a good CPA, and if they feel like they're not getting tax advice, we'll work on that and try to get them in a position to get some tax advice because I sometimes see that as lacking.
Yeah.
But we don't hold the money. There's an independent custodian that holds the funds, a Fidelity, a Schwab. That's the right way to do it. It's low cost and separation of funds from me as the advisor. And then the main advantage there too is in holding on to individual accounts and not being commingled, there's much more opportunity to design portfolios that are totally appropriate and specific to each client and their tax situation. And we orient portfolios to allocate investments into the optimal vehicle. So what should go into a trust versus what should go into a retirement account. And we like to put tax inefficient investments in these retirement accounts because they're tax sheltered. And so
Yeah.
that's something else we uh, can arrange that I think makes a big difference.
Yeah, that's a great point. And last question. There's there's sort of within the financial services industry and within the registered investment advisory firms, which Knightsbridge is one of, there's a sort of people have different concepts of investing. So you have what we call active investing versus passive, or they like to use the word evidence-based investing. What type is your firm, and why?
Yeah, that's a good distinction and a good question. We are a little bit of both. I'm a fan of index funds. I like passive. It's really the optimal for a taxable account because it's so tax efficient and low cost. So we typically incorporate in our taxable accounts some index fund, Vanguard style funds. And we even go further with some tax loss harvesting strategies that not just are tax neutral, but harvest losses, which can be valuable against capital gains. So we call our approach tax optimized investing, and we employ it more passively, whether it's an index fund or even if we're buying stocks in a taxable environment, we tend to buy stocks of companies we think we can hold for many, many years, trying to be very tax efficient. In an
Yeah.
IRA or retirement account, we will be a little bit more active where there will be some portfolio turnover and we will buy some stocks trying to beat the market. And we have over the long term. We are judicious about that because it's difficult to accomplish that. So we still, in that situation, will use some indexed passive exposure because it's just such a smart way to invest. So the nice thing about being independent is we get to decide all that. We choose all our investments and we try to do it thoughtfully, appropriately for each client's tax situation and type of account.
Awesome. Well, in our intents and purposes, whether you have, and it sounds like you're sort of employ both, but we are just more concerned really about the fiduciary standard and the relationship, because we can have a whole thing about what's better, what's worse, but that's not really the point. Um, in regards to working with a financial advisor, I think that as long as they have their best interests at heart, then you can come out ahead in either way. And I usually refer clients to people that some people are more sort of engineered to be active versus, or work with an active person versus someone who's more passive. So anyways, well, thank you. And so if anyone has any questions regarding John and his firm, please put them in the chat, and I think Eugene can probably get that to us. Okay, so why don't we just go ahead and get going there. John, I'm going to mute myself, but I may come on and ask questions or something along the way. I promise I won't be as interjectory as Peter usually is. So hopefully you can get a good flow.
Sounds
Okay,
good.
okay. Sorry, Eugene says please use the Q&A section for questions, not the chat. My
Q&A.
bad.
And I'll say that I'm going to run through my material quickly because not everything will be relevant to the audience. And so I'd rather go quickly and ask that you input a Q&A, a question through the Q&A to ask me to stop and expand a little bit or ask a question, and I'm more than happy to do that. But I'm trying to cover the broad ideas around retirement planning and funding and saving and spending. I usually get asked about my fee, and it says on this page I charge an asset-based fee, which declines annually. I'll actually outline that later. But let's start with the topic at hand. So, already talked about my firm. I'm happy to answer any questions about that. But really, the emphasis today among our investment principles are the first two here in blue. When you're thinking about retirement plans, you want a low cost plan. If you have an IRA account, you want your investment funds to be low cost. If you're setting up a 401k plan, you want it to be a low cost 401k plan. We do that through Vanguard. As I mentioned, there's huge tax deferral advantages in retirement plans and tax avoidance in a Roth IRA. You want to take advantage of that. You want to have the right investments in your retirement plans. And so, we're going to talk today about some of the ideas that help that, like finding the right retirement plan for you. Maybe you're already retired, but you have kids and you have some ideas. You can guide them on how they should think about getting ahead on their own plans. And then if you're retired, we call them smart spending strategies. There's a methodology, there's a purpose to how you spend. And lastly, we'll talk about expand on what Trevor described, some of the parameters around your estate, your withdrawal requirements, and things like that. But just to start and take a step back, maybe some of you are reaching the point of retirement, and retirement is a huge change. And this is a little softer part of the presentation. You have to be thoughtful and approach heading into retirement with both how you'll spend your time and how you'll make your assets work for you. Because once you stop working, you're dependent upon your assets, and you have to have a good spending strategy and a good way to draw down your funds and sustain your cash flow. So that's the work that we do is making sure we have a plan with our clients on how we're going to fund mostly every month some cash flow and income into their bank accounts, from which accounts first and which accounts last. And I'm going to show you that today. So in terms of finding the right retirement plan, if you're a W-2 employee, it's pretty simple. That's going to be probably a 401k. And your job is to try to maximize it out. So if you're working and contributing to a 401k, your goal is to hit the maximum every year if you can. If you're an independent contractor or you're a business owner, you can do a lot more. I'll show that to you in a minute. So those of you in the audience that are still working and are not just W-2, there's a lot you can do to maximize your retirement funds. If you're retired, then it's about your spending strategies, as I mentioned, and the opportunity to consider Roth conversions. And that's a specific strategy I want to show you today is in retirement, spending strategies and Roth conversions. We do them, we work on both, and they can make millions of dollars of difference. So let's start with the basics. If you're contributing, what are some of the amounts you can do this year? Let me move my viewer here. So let's just start all the way to the right, a traditional IRA. You can put $7,000 into an IRA this year, $8,000 if you're over age 50. That's tax deductible. When you take the money out after you're age 59 and a half, if you elect to, that's a taxable withdrawal. Pretty much all withdrawals from all retirement accounts except Roths are taxable when you take the money out. All retirement accounts except Roths are subject to required minimum distributions once you're in your 70s at a certain age. And there's an income limit on your ability to put money into an IRA. So all retirement plans have an early withdrawal penalty if you take money out before age 59 and a half. So that's kind of the basics. And these things all have income limits. You can see on the income requirements. So you have to be below a certain income level to make contributions. And if you do 401ks, you can do a lot more than an IRA or Roth IRA. So first level is an IRA or Roth IRA. Second level, larger amounts are going into the 401k environment. And the difference between an IRA, traditional IRA, and a Roth IRA, and same with 401k, is IRAs you're putting in pre-tax money. So you put $7,000 in, that's money you didn't get taxed on. The Roth is different. That's after-tax money. So you didn't get a tax deduction on the way in, but that money's never taxed again. So that's the power of the Roth is the rest of your life, once you put the money in, you're not taxed on it. So going beyond the IRAs and 401ks, you can set up a retirement plan that's more comprehensive. And I'm going to talk briefly about some other retirement design ideas. Why would you do that? Well, there's tax benefits for you and your employees. There's wealth accumulation benefits based on tax advantages. And it can be a reward to retain your employees, compensate your employees tax efficiently. And so we help clients set up plans sometimes. And there's a lot of variables to consider when you go beyond just an IRA. Things like, what kind of corporation, your number of employees and income and ages. There's a lot to think about on the left. We can talk through that to you. And then there's a lot of plan options on the right. So you could do, if you're a sole practitioner, you could do a solo 401k, low cost, tax efficient, and a way to increase your contributions. You can also do a SEP IRA, so simple employee pension. Those first two are very similar. And then the two at the bottom are more elaborate profit sharing and defined benefit. So just as an example, let's say you're a business owner, you're making a lot of money and you're paying too much in taxes. What do? Well, you design a self-employed retirement plan that has building blocks like this. So you might start with a SEP IRA or a solo 401k and get $30,000 to $70,000 into it that way. So I can help you do that. It's tax efficient, low cost, easy to set up. Or you can do a solo 401k and put in $76,500. The big difference you can make if you're a really high income is a cash balance defined benefit plan. And that is based on your income and your age. But the older you get and the higher your income, the more you can put in, potentially hundreds of thousands of dollars tax sheltered, where you get a deduction on your business every year. So if you're making hundreds of thousands of dollars, I could talk to you about the ability to put hundreds of thousands of dollars into a tax sheltered retirement account. Those are the building blocks. Happy to
John, for those particular accounts or those plans that you're talking about that are a little more personalized and not the regular run of the mill, do they still have the same, let's say, withdrawal rules and regulations as let's say just a 401k or a traditional IRA?
They do. That's a good point. So everything but a Roth, all the different kinds of plans, SEP IRA, regular IRA, solo 401k, they all have the limit of not withdrawing before age 59 and a half, and then a required minimum once you're 73 years old. So they all work the same way. It's the Roth that's the difference. And so
yeah. And then so for a lot of let's say for some of the attendees today that are already retired and have, let's say, they're not working anymore, so they're not contributing to their 401k or they don't have any earned income, but they still are, let's say, own one. What are some of the advantages and disadvantages of keeping it in the 401k rather than, let's say, rolling it over into a traditional IRA?
That's a good question. There is some thought that there's a higher level of asset protection keeping it in a 401k plan associated with an external entity, a company's 401k plan, for creditor protection, litigation. The trade-off is the 401ks have higher costs because there's record keeping administration costs. you can set up an IRA account, a rollover account to move the 401k over into your IRA rollover. And that IRA account has no cost. There's no administration. So you have much more flexibility in an IRA because you can invest in anything versus a 401k where you're limited to the plan options that plan offers. So generally people, when they leave a company for a new job or retire, they roll out of the 401k to avoid all those costs into a self-directed IRA rollover account that an advisor like me can set up so that that client, that IRA rollover holder has total flexibility at low cost.
Great. Yeah. And from my understanding, they're a little more like from the inheritance beneficiary designation forms. The 401k employer-based plans have a little more rules as to who's allowed to get the monies when you die. I think if you're married, most of them require that your spouse be the beneficiary, whereas an IRA, traditional IRA, you don't have to choose a spouse, you can choose someone else. So some of those considerations are there as well.
That's a good point. I'm glad you brought up beneficiaries, and we will talk about inheritance and beneficiaries at the end. But I'm so glad you started out talking about the importance of the registration of beneficiaries because I've seen this. We try very hard to make sure our clients are current on their beneficiaries. And every couple of years, we reach out and say, is this still the appropriate beneficiary for your IRA account? And sometimes things change and people forget to update their beneficiaries. And as Trevor said, it's paramount to make sure that there is a named beneficiary and that it's the right one to avoid probate, et cetera. And so if you've not checked on yours in a couple of years, or if you haven't talked to your advisor about who is your beneficiary, I highly encourage you to undertake that exercise.
Right. Okay.
Yeah. So just quickly, some of the details. And I think the best thing is, if you'd like, well, I guess we're going to post this presentation, but if you want to get in the weeds, these are some of the rules and pluses and minuses about these different kinds of plans. A solo 401k is the easiest way because you can put 100% of your income. So if you had a $23,000 income and you're a solo, worker, you can put all $23,000 into a solo 401k. And if you're over 50, you can put 30,500. You can put more on the left into these SEP IRAs, but it's only subject to 25% of your income. So you have to have a higher income. And then, as I said, the profit sharing and cash balance are how you go further with some additional limitations. So I'm happy to circle back on retirement plan design, but some of you are already past that point of forming businesses and forming retirement plans. So I just want to go over why in the first place we're thinking about retirement plans. They're highly tax advantaged. There aren't a lot of tax advantages available. You can deduct some of your state tax or your mortgage interest, but retirement plan contributions can be a really big one. So it's the tax aspect that drives this. And it's also the need to save. Obviously you stop working, Social Security is only going to get you so far, particularly here in Southern California. And studies show that you need generally 80% in retirement of what or you're going to spend 80% of what you were once you're in retirement. And over time, we know prices rise. So you have to think about the need to have a growing retirement portfolio, to have increasing spending over time. And a simple way to think about it is the price of eggs has gone from $1.26 to $2.07 as a national average. Gasoline from a dollar. I wish I could fill it for $3.99, but we've had prices increase on our daily necessities. The last 5 years, housing, food, gas went up 20-25% in the last 5 years. We have a lot of inflation. So the idea is you have a retirement plan, it grows, and you have the ability to spend more over time, and you need to plan ahead and save. And a retirement plan is the best place to do it. So for those of you that are older and have kids and grandkids, show them this slide about the benefits of starting early. And this is for someone, say, starting their career and they have a 401k and they're thinking about whether they can save and they're not sure because they want to buy a house or they have kids and they need to think about college. But getting a retirement account going, getting started in your 20s makes such a difference. In this example of Sam and Sherry and Sally. So at age 24, Sam and Sherry start putting in $250 a month into their 401k. And Sam does it uh, all the way to retirement and for 41 years until he's 65. And then he can take $3,100 a month in retirement. Whereas Sherry stops um, midway through at age 40, and she can only take $2,087. So, it's key to start and to keep going. And then the power of starting early and compounding returns from an early age. Sally waits until she's 40 and only has 25 years until retirement. She puts in twice as much, $500, but because she waited, she has the least per month in retirement. She only has $2,000 a month. So we encourage our clients and their families, and we work with the kids to try to start funding 401ks in their 20s. Even if it's a small dollar amount, it compounds and really adds up over time. And this is another way of thinking about it. So consistent Chloe, all these people are investing $200 a month, but Chloe does it consistently from age 25 to 65. Lila waits until age 35. Quincy quits, only does it from 25 to 35. And Nervous Noah does it all the way from 25 to 65. Put in that same $96,000 in total, but just was conservative or didn't deal with it and kept it in cash and made only 2%. And so you have to put the money to work, take some risk. It's a long time horizon on these retirement accounts. And you see the huge difference in ending values at age 65. Noah, who didn't put his money to work, only has $150,000. The quitter or those that invest later only have $200,000. The consistent funder that put in that $96,000 over their full working career ended up with a lot more money at $420,000. So that's the idea of thinking about how to approach saving and contributing to a retirement plan. Start early and save often and keep it going. Now, you reach retirement age, you're starting to think about how you spend and your retirement goals. And one mistake I see people make is they suddenly stop working and they get really nervous. And while they were working and contributing, they didn't pay much attention to their 401k balance. They didn't see that it was fluctuating in the stock market, and they had a really great rate of growth in the stock market, but they weren't scared by the bad years, the declines that came along. And so they retire and they say, oh my gosh, I need to be really conservative in my 401k. And they go to cash or they go to conservative income producing investments. And what can happen is they start spending principal. And then you're at risk of depleting your portfolio. So you need a return that can keep up with your required withdrawals and what you actually withdraw. And so what's nice is to have at least equivalency of the withdrawal rate and the return rate. And the way we invest is to try to have the return rate exceed the withdrawal rate to have the retirement portfolio grow so that over time our clients can withdraw more to keep up with inflation. So my advice, the optimal approach is a total return approach where you have some stocks, some bonds, some income, some growth to get a combined rate of return above that withdrawal rate that you're required to withdraw starting in your 70s. How do you do that? Well, you emphasize an appropriate asset allocation. So you need to match your investments to your retirement time horizon. And so if you're, in your 80s and you have to withdraw a large percentage of your IRA as required, maybe you have a shorter term goal and a more conservative portfolio that does hold some cash. But if retirement and big withdrawals are 5 and 10 years plus away, you want to hold more in equities, which are stocks, and some in bonds to be diversified because you have a medium term time horizon. But if you can't touch a retirement account until you're 59 and a half and you're still in your 40s, and you have a long ways to draw, or you don't plan to draw on your IRA until you're in your 70s, that's the important thing to have a sense of and set your investments specifically appropriate to that longer term goal and have more in the stock market, and you'll have a higher rate of return. And you can see at the bottom at least since the 1950s, the range of returns associated with different types of portfolios. So you always hear about your time horizon informing your asset allocation, and this speaks to it at the bottom. So equities, which are stocks in 1 year, the worst year lost 39%, the best year made 47%. But if you have 5 years, the range narrows, and stocks the worst year only lost 3% per year, and the best made 28%. So I always tell clients, do you have at least 5 years? If so, you consider investing in the stock market. And out to the right, when you have a 10 and 20-year horizon, cash did the worst in green and stocks did the best. But even a 50-50 blend of stocks and bonds did very well. So if you're not allocated appropriately in your retirement funds for your age in this sense, that's something you should talk to me or an advisor or do some thinking on if you're investing on your own. How do you make the most of your retirement plan assets? So let's say now you're in retirement, you're going to start drawing on your funds. You need to think about your different accounts, not just your retirement accounts, but you have three types of accounts. You have your taxable accounts, which would be, say, a trust account. That's after-tax money, non-retirement funds. You have tax deferred accounts, which would be an IRA or 401k account where you're going to invest without tax, but it's only tax deferred because when you eventually must withdraw from the IRA or 401k, you will pay tax. You're deferring the tax until you withdraw. And then there's the best type of account, which is tax-free, a Roth IRA or 401k. That money grows tax-free and is withdrawn tax-free. And so we counsel clients to sequence their withdrawals, have a strategy on withdrawing from their assets, because most of our clients in retirement withdraw 4 or 5% per year from their accounts to live off of, which I think is a very sustainable withdrawal rate, 4 to 5%. But the question is, from which accounts do we take those withdrawals? What's the smart way to withdraw? So the first smart thing is to not excessively withdraw. So this is a little technical, but on the left assumes a balanced portfolio that's 40% stocks, 60% bonds. And historically, since the 1920s, what's the worst returns that type of portfolio had? The 80th percentile, so the 20% worst type returns in retirement that investors had to endure. And if they were withdrawing 6% in a really bad market stretch, they actually could have run out of money in less than 25 years, withdrawing 6%. If they withdrew 5% in the worst stress test downside scenario for returns, they lasted 30 years. But if they were withdrawing 4%, even in a terrible investment and economic environment, they didn't run out of money. You know, they retired, they started withdrawing, and they were 100 years old and still had the majority of their capital in a worst case scenario. And on the right, you can see some probabilities again in that stress tested bad type situation. So if you're withdrawing at 4%, there's an 85% chance, even in a bad time, that you didn't run out of money. And you can see that there's a good chance that $1 million increased to, $3, $4, $5 million. So 4% is the golden rule that's sustainable forever. And I'm comfortable if you have the right investment portfolio with some stock market exposure, you can even do 5% reliably. But just rule of thumb, don't withdraw more than 4 to 5% per year to be sustainable in retirement. Now to go beyond that and be even more sophisticated with how you spend in retirement, we call it a dynamic spending strategy, which you start thinking about where to withdraw from, whether it's the stock market or the bond market. And sort of common sense, if you have a portfolio that's diversified in stocks and bonds, in this case, 40% stocks, 60% bonds, every once in a while, you can see at the bottom, there were losses in that portfolio in history. Whenever you have those losses, you take from whatever's not impaired. And that's what we do to fund our client withdrawals. We take a look at their portfolio and we're thoughtful about where to draw from. And you just don't want to sell things when they're down, let them recover. So it's most true for stocks. Stocks decline a lot more often than bonds. And so in 2022, when the stock market dropped 18%, we tried not to sell stocks to fund withdrawals because they certainly recovered in 2023, 24, and then we can go back to withdrawing. So it's dynamic spending where you think about what to liquidate and where to draw from to fund your spending. And that's a higher level way of thinking about spending from your investment accounts. So this,
Just to that point, real quick, John. So let's just think of an example. You have, let's say you have someone who's in their late 70s, early 80s, and they are realizing they need, they're starting to lose some capacities, or let's say activities a day. They need money for long-term care costs, let's say. Now, are you saying that where you take that money, given the from, let's say, your retirement accounts or your taxable accounts or other accounts, is an important consideration
I
for
am.
those types of things, or specific types of things?
It's there's a few dimensions. One is when you have to sell assets in whatever account, selling things that are not impaired in value if it's a temporary decline. Just trying, if it's a bad market, if you have some cash, better to draw the cash. If it's today and the stock market's at all-time highs, fine to sell some stocks to fund that withdrawal. So there's thoughtfulness about which investments to sell, but the other dimension to it is from which accounts to draw. And we are big on this slide on the right side. That's how we do it. You are better off withdrawing from your taxable accounts first, then your tax deferred accounts, which is an IRA, and lastly from your tax-free accounts, which is a Roth account. So when we have clients and they have all three, we go through a plan and we say, okay, we're going to uh, this year spend fully from your trust because you have enough in there. We can do that, and we actually can do that for the next few years. We don't want to totally deplete your trust, but we're going to spend it down some. Why do we do that? Well, because there's no income tax. The tax is on the investments, and we can make the withdrawals tax free from a trust. And then we're going to go to the IRA account, which is taxable when we withdraw, but we want to preserve the Roth IRA because it's the most valuable account because it grows without ever being taxed. And
Okay,
that,
so in those situations, as we are winding down, let's say, you would have the Roth, since the Roth is the last one you would touch, that would probably be, I assume, the most would have the most risk for
that has a
yeah, the most
higher
risk
time.
to higher
So we're going
timer,
to put more of the growth investments in the Roth. That's
or
actually
the
what we
growth
owe.
investments in the Roth. So you'd have that, and you wouldn't want to touch that because you want that tax to grow tax free as long as possible. Um, and then, but I guess what I was getting at is there's certain expenses that are tax deductible. Um, wouldn't you want to kind of, given the fact that, you can't use your trust brokerage account forever, that maybe you'd want to talk with you if those sort of, let's say, long-term care expenses or things like that, wouldn't that be something that would be suitable, let's say, to take more out of your IRA, given that you have those kind of dimensions in place?
Well, effectively the money would get distributed from the IRA. So it'd be a withdrawal, which would be taxable, and then would go into your bank account, and then you'd pay the long-term care and you'd get the tax deduction, and those
Yeah,
would pair against each other.
got it. Okay.
So another way to say that is if you have, so some other planning we do, let's say you're retired, you're not yet taking Social Security. If your income tax brackets are lower, your income's down, you're gonna have a lower tax bracket, less tax. We sometimes actually switch gears and take fund spending out of the IRAs because we're creating more income and more tax, but at a lower tax bracket. So you
Yeah.
have to think about each year and where you're at from a tax standpoint and what's the most advantaged withdrawal strategy for that year.
Exactly. Okay, so that's a good point. So it's not just always this, we do this first, then this, and this. There's, it's not as just clear cut as that. We have to kind of look at.
Yeah.
I mean, there are conceptually, of course, that would be a good approach, but there's, when you're actually breaking down your own expenditures and your own taxes and your own, let's say, needs, then you gotta look at all three, let's say, accounts and come up with a plan, a spend down plan.
That's well
Um,
said.
yeah,
Yeah.
so you got these three drawdown strategies to consider. Tell us about that.
Yeah. So what we don't take pro rata, we don't do the left. We don't just take it, equally from all accounts. That's not optimal. We do what I was describing, which is conceptually, generally, we'll take taxable money first, then IRA money, and lastly, Roth IRA money. And then higher level still is to look to do some Roth conversions, and I'll talk about that in a minute, to do some extra tax benefit uh, uh, planning around your different accounts. And then what's not on the page is what Trevor just explained, which is you need to tailor each year and the plan for the year to your specific tax situation and take advantage of any changes in your income tax that affect how that year should be approached. So, if you think about it, um, as you work and build up different types of retirement plans, when you're in your working years, you might be funding a Roth 401k or IRA because you're in a lower, earlier in your working years, you're probably in a lower tax bracket because your income's not as high yet. You don't need the benefit of the tax deduction of a regular IRA. So we usually encourage clients to fund a Roth in their 20s, 30s, 40s until their income gets high. And then they're transitioning into higher income later in their working years. And we maybe they do a Roth or regular, but later, the gray, later in their higher income years, the value of the tax deduction and putting pre-tax money into a 401k or an IRA is the best strategy. So when funding different options, pre-tax, after-tax, IRA, Roth IRA, think of it as a lifespan, a working year optimization of, is it better to get the tax deduction up front or after? And then you get into your 70s and you're taking RMDs, which are required minimum distributions. And so, you just kind of want to have a plan and think about what makes the most sense for you based on your income. So this is work we do. We take tax returns, we load them into our software, and we take a look at how incomes project. And this is what you should be doing in retirement. If you're in your 50s and 60s and early 70s, is thinking about where you're at with your income and your tax, and if you have any opportunities. So this client, they had their working years, their high income, and all of a sudden they retire at age 65. So the income basically goes away. They have a little bit of investment income. They're starting to ramp up their Social Security, but really you see the valley there between retirement and when at age 73 they're going to start having a lot of distributions from their IRAs and Social Security. This is probably the best thing I can share with you today that you may not have approached to try to optimize, but if you're willing to deal with a little bit of complexity, you can save millions of dollars, which is to fill up this valley here with some extra income doing Roth conversions. And here's what that looks like. You fill up the gap by taking money from your IRA and transferring it to a Roth IRA. That's called a Roth conversion. That's a taxable event that adds to your income. Roth conversions create income, but you're doing it at low tax brackets. And those lines show the lower tax brackets. And we try to make sure we use the 10%, the 12%, maybe even the 22%, those lower tax brackets to pay one-time tax at a low tax bracket and end up with more money in a Roth IRA that'll never get taxed again and have lower minimum distributions from IRAs because there's less money in them. And in this example, it turned a few $100,000 of Roth conversions into a couple $1 million more over the course of this person's life. So Roth conversions are a very powerful way to pay some tax if you have the money in your trust up front at a low tax bracket to move the money to a tax-free Roth IRA. That's the idea. We especially like doing it when the market's down because the value of the IRA is down and we're converting less dollars with less tax. You're paying tax on lower values, and then you get the recovery in the tax-free Roth IRA. So you have to have the cash to pay the tax. You're going to have income tax the year you do it, but we do a lot of Roth conversions. And if you've never looked at that, if you're not yet taking full Social Security, you have a window of opportunity before you're taking IRA minimums and Social Security.
I have a question regarding that. Does the income you earn during when you make the Roth conversion, so the year that you, let's say, do the Roth conversion, does the income you earn during that year have any effect on taxes or anything of the IRA, let's say the traditional or SEP IRA that you're converting to a Roth? Or is it only based on what's already been deferred in that account?
The tax implications is based on your total income, inclusive of the conversion. So
Okay.
if you had $50,000 of earned income and then you converted $50,000 of your IRA, you now have $100,000 of income you're going to pay tax on.
Okay, got it.
So it's the sum of what you already were earning and paying tax on, whether it's wages or interest or dividends plus the conversion amount
Got
determines
it.
your tax.
Okay, because that's coming up. Okay, and then a couple factors of that, like that people, because it's a lot easy to say, "Oh, just go do this," but it's not something I don't think people should really do without getting some professional, financial advice from someone like you. Um, what are some of the like factors where, because you said, okay, let's say you have $100,000 IRA that you want to convert to a Roth. Um, you said you don't, from what I picked up, you don't really want to pay taxes from that particular account. You'd want to be able to make sure you can pay the income tax from a separate account.
It defeats the purpose if you have to make more withdrawals to pay the tax. So don't do it unless you have to have both the combination of an IRA balance and a trust balance where you could use the trust or your checking account to pay that extra tax. Number one. Number two, don't do this at home on your own because it's the details. There's, you have your tax deductions. What is your marginal tax bracket? We put your last year's tax return into our modeling financial planning software, and we model it out looking at your specific tax brackets and tell you exactly what it's going to require in extra tax payments. And then we like to send that over to the client's CPA and just have the CPA say, yes, this makes total sense. I think it's a good idea. Let's do it. But there's other implications like we don't want to get your income above $200,000 and kick in the 3.8% Medicare surcharge. We want to look at how much more per month your IRMA Medicare supplemental costs might be increased by this. So there's detailed pluses and minuses, and we want to consider everything. But the
Yeah.
big idea here is that um, if you're in a low tax bracket, it'll make sense, but not
Right.
if you're in a high tax bracket.
And they and another, I guess, reason why you wouldn't really want to because you, again, what we talked about before, you would want this to grow conceptually tax-free as long as possible. So you'd want some sort of time horizon, right? Like this wouldn't be something you'd want to do, um, and then 5 years later you drain, the account, right? You'd want some sort of tax. So instead of paying the taxes from the same account and starting at 70,000, let's say, as your Roth, you would want to start at 100,000 and get that compounded growth as long as possible.
That is true. If you were going to need to withdraw a lot from the IRA or the Roth IRA, it defeats the purpose because the benefit is you're transitioning to a Roth IRA where you don't have to take distributions. It's not going to create more income and raise your tax bracket. And you're going to get to grow the Roth IRA tax free and then eventually take it out tax free. The value of that of tax avoidance compounds with the years. So it's,
Yeah.
makes a big difference after 10 and 20 years. So if you're 90 years old, it doesn't make sense to do it probably. If you're 60 years old, you're going to have to really rely heavily on your retirement assets, it probably doesn't make sense. This is where you've been fortunate to amass a large IRA balance, and you really don't need it to withdraw a lot, and you've got the likelihood it'll continue to grow, and you'd like it to grow without having to deplete take withdrawals.
Okay, thank you.
Mm-hmm. Yeah, so I'm happy to talk offline, follow up on someone's specific situation about these Roth conversions, but we do a lot of them. They've been highly additive as long as we can do it in low tax brackets. So you just kind of have to think about your tax rate now versus in the future, and you always want to pay your tax rate when you're lower than later. And if you're in a, like I said, if you're in a low tax rate now, you want to do some Roth IRA funding or conversions, but not if you're in a tax rate that's higher now. And so it's just kind of a consideration about your tax situation. So now I'm going to finish with some of the rules and constraints around having a retirement plan and your beneficiaries and your heirs and how distributions work. And I'm sure Trevor will have some input on this as well. But in terms of required minimum distributions, so you have a regular IRA, not a Roth, but a regular IRA or 401k. The laws changed recently, and now under something called Secure Act 2.0, the last couple of years they've updated retirement rules. You get to take a required minimum distribution starting at age 75. And so as late as age 75, I should say. And at the bottom, it's based on your age. So the year of birth on the left. So I was born in 1971. I will be able to take no withdrawals unless I want to until I'm 75. And then after age 75, I'll have to take out a certain percentage per year based on my age. If you were born before 1950, that age is 72. So they've created different required withdrawal points based on your age. That's how that works. And that's just a percentage. It's based on your age of minimum. And then what also changed is, well, let me go back. So this is for you. Okay. So if you have your own IRA or 401k, and then let's say you've inherited from a spouse an IRA or 401k, same exact rules apply. So that's an important thing to understand. If you name it your spouse as your beneficiary, they'll get to operate the same way as you if they end up inheriting your IRA. It's interchangeable for spouses. It's different if your kids inherit an IRA. The law changed, and now if your kids are the beneficiary in your IRA and they eventually inherit the IRA, they're going to have to by law deplete the IRA in 10 years. Okay, that was a change. They've been evolving these rules for non-spouses, and all the way to the right is how it works now. The IRS now says, number one, you have 10 years for the kids to fully withdraw the IRA. Number two, starting in 2025, those kids have to take minimum distributions. Okay, so that's a big change, and it affects how we invest those too, because all of a sudden that's only a 10-year time horizon, and there's going to be regular withdrawals. So the 10-year rule, if the parent wasn't yet taking minimum distributions, then there's no required minimum distribution. If the parent was over those ages in their 70s taking required minimum distributions, then it brings into force this every year take a distribution for the kids. So it sounds complicated, but it's really not. If the parents were taking distributions, then the kids have to as well. And if the parents weren't yet old enough to have to take distributions, then the kids don't have to either. But either way, the kids have to deplete the IRA that they inherit in 10 years.
Okay, so that given the fact that some of these are pretty large accounts, that sounds like there's some you would probably, it would be best to have some good tax planning there. Yeah. And
So we do a lot of planning here because even though, let's say, starting next year, some child inherits a $2 million IRA and they have to take a percentage out per year. Let's say it's 5%, so they're going to have to take $200,000 out. it may make sense to take out more if they're in the lowest tax bracket they'll be for that full 10 years. So we sometimes adjust the withdrawal for the year, not just to be the minimum, but to take advantage of, kid goes back to graduate school, they have no income. We're going to withdraw more from the inherited IRA those years.
Right.
It gets back to what we keep saying, which is it's all about your specific situation and your income, whether you're the child or the parent. And there's
Yeah.
pluses and minuses to take certain actions based on variation in income.
Okay. So to sort of contrast to how it used to be, let's say 6, 7 years ago, if you inherited a traditional IRA, from my understanding, the IRS would say, okay, here is your actuarial table. You have, you have the rest of your life to stretch this, and to take it out by your own, however you want. But this new Secure Act 2.0 has come along and said, no, we're not stretching it for the whole lifetime anymore. You're only allowed to do it for 10 years. Now, that's still 10 years, right? It's not like they're saying you have to take it out that year and get all that income. But it does obviously shorten the stretch. I guess that's the term we use, stretch. So to your point, tax planning can be a factor on a larger IRA. And sometimes, like you said, the income from their large IRA might match or even exceed the income that they have currently. So it's sort of like, they're kind of in this situation where that's why at the beginning of the class, I'm like, you have to educate. If your kids are going to inherit these things, first of all, you should probably know what marginal tax bracket they're in, and educate them as to why, they have to be careful when they inherit income regarding the tax situation.
And now that these rules apply, we do a lot more planning, thinking forward about the implications of the kid's inheritance and how it's going to affect the kid's income situation and strategies we can employ to address that. Because just like you said, Trevor, sometimes all of a sudden the kids have a massive tax problem, especially now that real estate comes into this as well, because they can't keep the house because the property tax goes up. So, there's a whole lot of planning around inheritance now.
Right. Okay. Um, is this a slide that is looks like it's got
This just gives an example. I think we've talked about the 10-year rules, and I'm not going to spend any more time, but I'll take questions on it if it's unclear to anyone. This is my last slide, just reminding you some of the 2024 amounts. So there's some deadlines, some amounts, and this is posted online. So if you're contributing anything, you can look at some of those limits. Just 2 minutes on us as a reminder. I mentioned our fee schedule. This is how it works. If we're managing these retirement accounts, clients with $1 million, their first year fee is 1.1%, and then it declines until it's 0.75%. It's kind of unusual, a declining fee. I'm proud of our creation of that. Not everybody does that. And the way we try to be a good resource is help clients make plans, do it in a sophisticated way, talk directly to our clients as the investment team that's invested alongside clients that knows the client portfolios. We don't just put clients in mutual funds. Clearly, we work with client specific tax brackets and design things very specific to each client's and our status as fiduciaries, analysts, investors, and being independent. So that's kind of our hallmark. If any of you want to portfolio review, more than happy to do that. You can go online in a week and catch my contact information here, or just call my office at Knightsbridge. So,
okay. Thank you.
well,
let's take we got some time. So we'll take some questions. And one of the things I wanted to, going back to, why don't you just stop sharing your screen, John, so we can see you. So regarding inheriting, okay, remember back to these beneficiary designation forms. Often you can fill these out yourself. You can go to the, Fidelity website or wherever that's custodied and change and amend them and do all these things. And they're not always fact checked. They're not always filled out properly. My recommendation is if you do fill out beneficiary designation forms, that you print them out, put them with your estate planning binder so whoever your trustee or your executor knows who your beneficiaries are. There was a question earlier about, hey, how do the beneficiaries know they're beneficiaries? Well, often I serve as people's successor trustees and executors. If the trust is not a beneficiary, the custodian will say, sorry, you're going to have to get the beneficiary to reach out to us. I can't help you. So they can't even really, there's like this weird game where we're trying to figure out who's on the, if I don't know already, who's on these accounts, who can we, and they can't really talk to me legally because I am not the beneficiary. So, but once I find out, I'll try to find the beneficiary. Usually it's one of the trust beneficiaries, but not always, and get them a death certificate, give them instructions, but they have to deal with it themselves individually. Not, it's administered. I mean, this gets the dispositive provisions of these beneficiary designation forms are going to the individual, not the trustee of the trust, if the trust is not the beneficiary. Now, going back to that, you basically have 5 options in this. The first is your spouse. Very simple. You can do a spouse. The spouse that inherits can do a spousal rollover. They can basically just combine their IRA with their spouse's IRA that's deceased. Correct me if I'm wrong, John, but that's kind of the concept. Now, what's changed is if you want to name your adult children, or any friend, let's say that's more than 10 years younger than you. That is also, if you name a friend, if they're less than 10 years younger than you, then they don't have this 10-year stretch problem. It's only for if you're kind of, and a lot of us do, we'll name our children as beneficiaries, okay? Or if there's people younger than 10 years. That's the second option, people that are not spouses. The third option is your trust. If you have a trust, you can name the trust as a beneficiary. Now, there are complexities to that. It isn't from an administrative standpoint, it sounds like a good idea because everybody, it's the beneficiaries are the same as my trust, and I just want it to go the same. But what happens is the trustee then has to open up an inherited IRA for that decedent's IRA. Now, how do we determine required minimum distributions? Well, there's, if the decedent's over 73 when they were taking RMDs, this is the new law, then we have to take. So they look, there's all these things. Now, the distributions that come into a irrevocable trust, which is what it will be, it comes in as income. John, let me ask you, are the marginal tax brackets for irrevocable trusts the same as individuals?
No, they go to the highest rates very quickly. And so
Right.
we try to distribute all income out of the irrevocable trust
Yeah.
to.
Good point. So what happens is the trustee receives the income, but he doesn't want to keep it in there, right? He has to understand that, or she has to understand that income, let's say they take 50,000 because that's the required minimum that year. They have to get that out of the trust and into the trust beneficiaries in the same year to avoid what could be a quite onerous tax. So not that that's insurmountable or anything, but it's just something. It adds a level of complexity because of the compressed marginal tax bracket of an irrevocable trust. you might as well just name them as individuals outside the trust. It's outside the trust administration. It's all super simple. The fourth option of inheriting is charities. Okay, 501c3s. All this stuff we're talking about, income tax implications and problems and this, go away. Why? Because they do not pay income tax. They'll get the full amount and don't have to worry about paying income tax. So these are what, and we're going to talk about this more next week, but these are wonderful assets if you have charitable intent in your estate plan to look at for those goals because of that reason. Okay.
Trevor, when you're finished, I want to add one thing.
Okay. This is my last point. The fifth option is, if let's say you have a large IRA, you can do all of the above. You don't have to give it to one specific beneficiary. You can put 20% to a child, 20% to a charity, 20% to a friend. Like, you can do that on the beneficiary designation forms, and that can happen. Okay. Those are my 5 options. Go ahead, John.
I wanted to mention one really important strategy that I didn't include in my material. So this is back to having a retirement account and being at the age where you have to take minimum distributions. So those are set based on the minimum distributions are set based on your age, and you have to take them, and they're taxable income to you. There's a way to avoid that tax, and that's to make qualified charitable distributions. So while you're alive and you've got your IRA and you're in the year where you take the distribution, instead of you taking it, as long as you're age 70 and a half and up to $105,000 maximum, you can have that distribution go directly to charity and there's no tax on it. So that's far, if you're making charitable donations of any kind, don't do it with cash. Never do it with cash. Always do it with either IRA distributions or appreciated securities. So many of our clients make donations to nonprofits, and we send over their appreciated stocks or part of their IRA distributions. Very helpful from a tax standpoint. And you can do it every year. You can do it from any kind of an IRA account, SEP IRA, rollover, contributory, and all you have to be is 70 and a half years old, and there's a maximum. It's $105,000 that amounts indexed for inflation. It'll go up over time.
Yeah, that's a great point. And that's gonna be something Dawn's gonna talk about next week in this webinar. It's funny you said that. It's hard to see because of the thing, but I just got a qualified charitable distribution from Peter Coate from his IRA to financial and estate literacy, our thing, and for $9,500. So from my understanding, this $9,500, to your point, was part of his required minimum distribution that he had to take from his IRA. However, because he didn't take the money he didn't actually receive the money himself, it went directly to the charity. Therefore, but from my understanding, what you're telling me, it still satisfies his required minimum distribution requirement, or at least partially or fully, whatever it may be.
It counts toward it.
So it sounds very tax-wise way of giving.
Very much so, because if you donate stock to a charity, you get a tax deduction and you avoid capital gains if you had sold it. So that's what's good about that. But the IRA, if you donate $10,000, you didn't pay tax on that. That's like if you had sold a stock. That's like if you'd taken $20,000 from your IRA, paid half in taxes, and turned around and give it to the charity. It's like you almost get to give twice as much and help your charity twice as much.
It's a wonderful. You'd be the talk of the cocktail party. It's a wonderful way to give, and if you're already giving and you're taking your RMDs, this is a slam dunk. And we're going to talk more about this next week. There are some. Eugene, have we answered all the questions, or should we address some of these out loud, maybe?
Sure. I'm just going to go one by one.
Okay.
All right. It says, I am the beneficiary to my husband's financial accounts. Would it be better to be listed as a co-owner of the accounts?
Well, depends on what the accounts are. If you're talking about these retirement accounts that we've been talking about today, that would not be possible, right, John? You can't just join
Yeah.
your husband's
If
IRA.
it's a retirement account, be named as the beneficiary. If it's a taxable account and there's a trust, it's probably going to be accomplished through the trust. If there's not a trust, it can be accomplished through pay on death. A couple can just take a taxable account and name as pay on death to each other and avoid a trust that way. But um, depends on the type of account.
Yeah. Co-owners, I mean, spouses, it's usually not that big of a deal. But it can depend. Like, and I'm thinking about family dynamics and things, but maybe if it's the third or fourth spouse, that could be issues. But
If it's super simple, it's just joint tenancy with rights of survivorship is,
yeah,
it's
yeah,
almost all of our accounts are either a trust or joint tenancy with rights of survivorship when there's a spouse.
right, or community property.
Or
The
community.
Yeah. So I don't know, Denise, if you were talking about what type of accounts you're referring to. But yeah, spouses, there's a lot, this is a lot easier to do than if, let's say, you're a child helping out dad. That is a little more sticky, meaning coming on as co-owner, that means you now own it with dad. However, go back to a couple of weeks ago when we talked about power of attorney. If it would be best for the rest of the family that you don't own it with dad, perhaps you can just become power of attorney and then help dad, but you don't own it with dad. But spouses are a little different. Okay.
So I went to the very bottom. She mentioned it's not for retirement accounts, but regular investment accounts.
Okay. Yeah. Well, then you could put them in as community property, or if you have a living trust, that would assume also that they're owned as community property, and that would probably be the best way to hold title.
I'm going to skip over to another question that might be related. It says if you get divorced and don't change the beneficiary in this is 401k plan, but maybe it's all retirement plans from an ex-spouse, what happens when you die?
You have a big problem.
Yeah. Yeah.
That's why these things are so important to look
Yeah.
at, you guys. You got to keep knowing what they are, put them in with your documents so you always know. But I'll tell you a story. This is what happened. I mean, I see this a lot, mainly with men because we're a bit absent-minded, but we will, when do you open your retirement accounts a lot of times? When you're starting out, right? You just got your job, you just got your new 401k, and you put your spouse on as the beneficiary. Well, life goes on. You've worked 60 years, this and that. In between, you've had two more spouses. Okay. Now, have you thought to go back and change that? Because you haven't really done that since 40 years ago or whatever it may be. And that's where I see this sometimes. And it's a problem. Now, if it's a 401k, often the administrators will have some sort of system where they kind of work through that. But for an IRA, I'm not sure. I think they'll just look at the beneficiary.
No, this doesn't go for just retirement. If the institution, even if it's just a regular checking account, if they have a paid on death or some kind of beneficiary listed, they will first not talk to you because they don't know who you are. And even after that, even if you identify yourself and you try to prove whatever, they usually go with whatever they have listed on file. So, for example, if you think of yourself as the bank, right? Like if you opened it for Trevor and Trevor says, "Hey, hold my money for me. By the way, when I die, give it to this person." And then, years go by and then you are not told something changed. Well, you can't take their word for it, right? They might be liable legally. So this may go to court, but it really depends on what the documents were at the time and how things played out. So, um,
Okay. There's some questions. Why don't we talk about the minors
okay,
inheriting?
let's see here. Let's do Does the 10-year rule apply to grandkids, siblings, and anyone non-related?
Yes, it does.
Yes, anyone other than spouse.
Okay. And
Yeah, anyone
then
other than spouse. But keep in mind, yeah, someone asked, can a minor inherit a retirement account as a beneficiary? First of all, not recommended. They do not have a signature. They cannot legally inherit it. So you're hoping that the custodian or the guardian or parent of that minor will steward that, let's say, income in this case, to when they can, they're old enough to inherit it. Now, regarding the 10-year stretch with that, though, because this was a question we had in another session. From my understanding is the 10-year clock does not start until they hit the age of majority. So if you're 4 and you inherit someone's IRA, you don't have to pull it out in 10 years while when you're 14. You have to, it can be whatever, and then when you turn, I don't know if it's 18 or 21. I don't know if age of majority is based on IRS rules or just,
state
adult.
specific.
Yeah, state specific. Okay.
Yeah.
So that's when the 10-year clock will start for that type of thing.
Okay, so I think those are 2 questions, right? So can a minor inherit the retirement accounts as a beneficiary? And what are the rules and requirements of inherited real estate? Oh, real estate to the inheritors.
Well, real estate, it depends on how they hold title to that real estate, the decedent. If it's in the trust, it'll pass through the dispositive provisions of the trust. If it's in community property, the spouse will inherit it. If it's in joint tenancy, the surviving joint tenants will inherit it. So it really depends on title. Title.
Yeah. And then a while back, Denise asked if she's curious about the tax bracket calculations, what program is being used. I guess, John, do you have a program that's specific?
Yeah, we have 2. One is a financial planning software tool we subscribe to, and the other is specifically for spending strategies and Roth conversions where we can model out, like I said, putting in that person's tax bracket and modeling scenarios of different spending strategies and different Roth conversions. So it's not proprietary software, but it's some expensive software we subscribe to that we can use in working with whoever asked that question or anyone interested in that analysis.
So we can't buy the software at Costco?
I wish. I don't know. These
Okay,
days,
no.
maybe you can.
No, but it's true. You guys, I mean, all your firms that are established and have been around prescribe or subscribe, I should say, to a lot of this ex relatively expensive software that may be way over the top for just one individual. So, great. Okay.
Oh boy.
Oh boy.
I think this is related to the question about the programs. Morningstar Direct. Yikes. Yeah, this is
Someone just put out that.
yeah, there's a lot of okay, there's more questions that came in. How does Step Up work for children inheriting real estate after husband and wife have died?
So when there's an estate being settled, there's something called a step up in basis on all the assets, whether it's your primary residence, a rental property, your stocks, they get stepped up in basis to the current value, which is really nice. So when we're investing, we hold on to highly appreciated assets for clients that get older for that reason. So the good news is the real estate that's highly appreciated, can potentially sell it without a big tax burden. The bummer is the property tax goes up too, so makes
Right.
it difficult to hold on to that property.
Now, just from a conception, because remember we're talking about retirement accounts today. How come we don't worry about the step up in cost basis of the assets in IRAs and 401ks? Because that
There is
doesn't
no
seem to factor.
basis.
There is no
It's not a
basis.
fact, not a factor.
Yeah. So all that stuff. So we don't even need to. I mean, honestly, keep track. I mean, because everything comes out as ordinary income. We don't like separate capital gains versus ordinary income. Correct?
we do from an investment standpoint. I want to put in your IRA everything I can that yields 8, 10, and 12% that's would be totally taxed at a high bracket because we avoid that. So has
Yeah.
investment considerations, but not estate considerations.
Not estate considerations, because when it comes out, it always comes out as ordinary income,
Always, unless it's a Roth.
unless it's a Roth.
All
Okay.
right. Well, it's the bottom of the hour. Feel free to stick around after the program if you want to answer any more questions. But just for the video, I'm going to close it here. I'm going to thank everyone for attending. But again, stick around after we end. So if there are more questions, we could answer them. Thank you, John, so much. Thank you, Trevor. Glad you guys were able to make it. Thank you so much for your time. And everyone else, have a good day.